Welcome to David and David on Real Estate. Join us as we explore the ins and outs of the real estate market.
Good morning and welcome to the David and David on Real Estate podcast. We are today on episode number 59. And we have a very special guest. We're super excited. Actually, we have a lot of great guests, but David Korman and I were actually chatting just before this podcast began, before I pressed record. And we were really looking forward to the topics and really getting into some of these discussions. And we have today Carl Gomez from CoStar. Welcome, Carl. Thank you so much for joining us this morning.
Thank you very much, David and David. It's great to be here.
Yeah, you can't confuse our names.
Carl, we love the background you've got there. Vancouver is a beautiful city and it's a great background, but that's just your background, just so we don't confuse any viewers who are going to be watching. And maybe give us a little bit of information about CoStar and what you do at CoStar, just so everybody will understand the credibility that we know that you're bringing to this conversation today.
Sure. So I'm Chief Economist and Head of Market Analytics for CoStar in Canada. I've been here since 2020, November 2020. I was hired right in the pandemic. Before that, I was with Quadrille Property Group, Bentall Kennedy. I've had about 25 years of experience in real estate, investment management, and economics. CoStar is a bit of a shift for me. It is a real estate technology firm, one of the largest in the world, a leading provider of real estate analytics information data to the real estate community, not just in the United States. We've expanded in Canada. We're in the UK and expanding through Europe. It's a comprehensive real estate technology firm that just offers a great platform for anybody involved in real estate to get information on the market. My role is basically to head the Canadian side, expand the analytics, and to do what I'm doing here today, talk about the market, give the trends and insights, pulling out the stories from the data.
My mind's blown. There's so much to unpack there.
Yeah, do we have 8 hours to do this? Because I got a lot of questions.
I'm happy to go 8 hours.
Well, we're in a very shifting economy. Like, David and I talk about this in the podcast all the time, and we're amateur people when we're trying to analyze the economy. We're always looking for trends and figuring out how it affects our businesses and the real estate market. And we focus a little more on residential, but we're always, we're touching on the commercial market as well, because David's got agents dealing in the commercial market. I do a lot of legal work in the commercial market. So we're always sensitive to that too. So your insights on this, are really valuable to us personally and our firms, but to hopefully anybody that's going to watch this podcast at large. So maybe just talk a little bit about what you're seeing now with the increase in, just the interest rates alone and the effect that's had on the economy.
Well, everything needs to be put into context here. I mean, we're coming out of, once in a generation sort of lifetime event with the pandemic. I think, context is everything here. Going into this pandemic, everybody was worried about it, including most policymakers. And as they should have done, they lowered interest rates to all-time lows. They opened up the floodgates of monetary liquidity to get the economy going. Well, guess what? Real estate obviously is a very dependent asset class to interest rates. And when you lower interest rates down to zero, you unlock a frenzy of demand. At the same time, the pandemic is and I'll say this, the pandemic has accentuated trends that were already there before the pandemic. One of them was, a little bit more inward looking, focus on the home, the migration trends that we can talk about as well, where people were moving outside of major cities. Technology facilitated that. But, that in combination with lower interest rates, or remarkably low interest rates, unleashed a huge swath of demand. And as anybody knows, living in the GTA, across Canada, even the United States, low interest rates drove up the housing market. We saw, 25, 20, 30% year-over-year gains in housing prices. A lot of that growth was coming in suburban areas and ex-urban areas. There was just a lot of demand for real estate, and low interest rates facilitated that. But, looking where we are today, we're coming out of this pandemic, hopefully. I mean, it's not a done deal that the pandemic is over. But what is over is that the lockdowns have stopped. the economy is opening up, demand is starting to move forward. And the Bank of Canada and other central banks realize that you can't keep, the gas pedal floor it down to 100 and juice up the economy. The result of that usually is a little bit of inflation. We've got a lot of inflation because of supply chain disruptions coming out of this pandemic as well. So they're in a hurry right now to raise interest rates back to what I would call more normalized levels instead of extraordinarily stimulative levels. When you start doing that, and you also get media reports, highlighting the fact that rates are going up, inflation is soaring, this could be the 1970s, you're going to get some panic, you're going to get some standstill. And that's exactly what we're seeing now in the housing market, is a reaction to those higher rates. Those higher rates haven't even flown through yet. A lot of people are still, pre-approved for very low rates that they got 6-7, months ago. But the net reality is there's been a pullback in demand. At the same time, we've seen some supply come off the market because those people who were trying to sell at the top of the market realize now that they're not going to get the top of the market. So there has been an adjustment in the housing market. A lot of commentators these days have been talking about a crash and using these big exploited sort of terms. What I prefer to say is that there's a correction. You cannot have any asset class growing 30% year over year every year, particularly an asset that on average costs over $1 million. So we are seeing a pullback in pricing. That makes a lot of sense. I don't see any distress in the market that causes what I would say a crash, but there is a normalization now of the market in recognition of the fact that interest rates are normalizing as well. We'll see where this goes. Everybody's crystal balls are fuzzy. As I said, this pandemic is a once in a generation sort of standpoint. We don't really have many historical reference points to kind of figure out where things are going. But, in my mind, the housing market is fundamentally strong, fundamentally stable. There are fundamentals that are there that will continue to push pricing up. And not every instance of correction is happening. I just in my own local neighborhood, I'm looking at, some sales that are happening. I live in Oakville, Ontario, which is one of the markets that really took off. And, there is some moderation happening, but even just, right outside my doorstep, my next door neighbor who bought their place back in September last year managed to sell their home in one day for a price that was just slightly above what they bought last September. Now, she's a realtor herself and a broker and out there, not to shout out to her, but her name is Tracy Feltman. She's definitely, pushed, told me that there is demand out there. So I'm speaking to people who are involved in transactions. And they say demand is there. It's certainly not as voracious as it was before, but, basically it's still going.
So Carl, the amateur economist in me looking at this for the last, few weeks or month or more, has sort of thought, because of the increase in interest rates, and when it first started moving up, we were sort of told right then this is the first of likely to be a few, and some of that's happened. So I just sort of felt and looked at it that, what's going on right now is sort of like a pause in the market. So everybody is sort of recalculating, like the demand might still be out there. People still want to move. They wanted to move in May or June. They want to change where they're living, but they're not sure what they can afford right now. They're not sure where it's going. So I'm thinking I'm hoping that maybe this is just a pause. Everybody recalculates what they can afford. And then, and it's summertime anyways. And by the time you get to the fall, it's okay. This is what I thought I could afford $1 million. I can only afford 900 maybe now. And so let's look for a $900,000 property, and they get back in the market. Like, is that like a fair analysis that it might be a pause?
Yeah, I think, a pause in the sense that we're coming off of such significant levels that I don't expect those levels to go back up to where they were before. Again, coming back to the analogy of once in a generation standpoint, we had a once in a generations situation with where interest rates were, keeping them at zero. Not to say that it might not happen again, but, right now, normalization of monetary policy says that's not going to happen. So to your point, I think the market is recalibrating. Some people, will get used to 0% interest rates. Oh, I got a variable mortgage for 1.25. This is fantastic. It's like free money. Now it's above 3, could get up to 4. Those are still low historical levels, but people are not attuned to that. And certainly when you get media reports of talking about, oh, the housing market's coming undone and real estate's a bad investment, blah, blah, blah. You get people who have to redo their homework. I've always said, I used to be a bank economist at, TD and RBC. And when we were talking to clients, real estate's always a local game. It's also a game based on your personal finances. If you can afford a home, if it's a long-term investment, you're not looking to flip or anything like that sort of thing, you run the numbers, you should be okay, but you have to recalibrate based on what the effective interest rate that you can reasonably afford to use is there. So from an ownership standpoint, I see this as just a recalibration. For investors in the market, I see the same thing. Their pro formas were done based off of very low interest rates. Obviously, with those interest rates now adjusting, their relative yield on cash flow might be impacted, versus something like a GIC or something like that. But, at the same time, we're seeing rental demand increasing and rental rates going up. So again, it really comes down to doing your homework, doing the math, understanding it, not getting caught up in emotion that's being generated by the media and by the market picture.
Carl, I love what I'm hearing. The economist in me doesn't really understand the replacement cost when it comes to real estate, right? And also the labor market. I mean, those are two variables that really contradict the whole philosophy that the real estate market is going to crash, right? Because when you look at construction costs, when you look at material costs, when you look at labor, I mean, the demand for the prices is just rising. Contractors want to be paid more. There's a big shortage in terms of labor in the construction field. Materials are going up in value as well. Gas prices are going up, right? So when I look at, what is the cost to construct, a new custom home, or what is the cost to construct an industrial building, or, if a cottage burns down, what are the replacement costs going to be to rebuild that cottage? It just doesn't seem likely that we're going to move back to those construction costs that we've had 3, 4, 5 years ago. I just don't see a general laborer saying, okay, you know what, pay me $20 an hour. I'm going to be happy with those rates. Now that costs have really gone up in terms of the labor market. So when I look at the fundamentals and kind of look at, what's happening to real estate on a replacement value or on a construction level, it just doesn't seem like we're ever going to go back to those ways where, costs were low to build a house. Like I remember my parents bought their first house in 1999 in Oakville on 8th Line in Dundas. And they paid, I think, $230,000 for a 2,000 square foot house that was built by Sundial backing onto a park. I mean, you can't build a quarter of a house anymore for that price.
Yeah, I absolutely. I think construction costs, the input costs to build a home, whether it's a home or even a commercial building, when I look at the stats, we talk inflation is about 7-8%. Construction cost inflation, and this is just the inputs in construction costs, not even the labor, is growing at 25 to 30% year over year. Now, if you're a developer and you're performing your costs increasing 5%, well, 25% just is going to put you offside and you're not going to be able to do that. And guess what? We're already seeing a lot of construction delays and projects being canceled as a result of what you're talking about, which is construction cost inflation. My personal view is that I think a lot of the construction cost inflation that we're seeing right now is an offset of the global inflation that we're seeing in commodities and everything else. And it is a big part is coming outside of the pandemic. Again, there's shortages of goods, they can't move things. And so that's really impacting real estate. But my personal view from a more long-term situation is the other big cost in constructing real estate, and where I see most of the value in real estate in the GTA, even in Vancouver, is the land. And where the heck are you going to get land to develop a single detached home when municipalities are saying to you, no, we want to put this up. No, we can't develop around the green belt areas. There are policy restrictions around that. And so the price of land just continues to go up. So in my mind, from a fundamental standpoint, the structural shortage of land available for development in a key region like the GTA or Vancouver or the island around Montreal only means that the supply pressures on that side are the fundamental factor that will keep pricing high. You open up the green belt in Toronto, or you open up the agriculture or Aboriginal Land Reserve in Vancouver, you have a lot more land out there, your pricing won't go up. You can put it, the greatest thing that people demand right now are single detached homes, ground oriented homes. They're going out to Guelph, they're going out to Peterborough, they're going to these places to find them because they're relatively affordable, but the prices have gone up there as well. You open up land like we do in Texas to develop detached homes, you won't be seeing detached homes at $1 million. You'll be seeing them at 500, 600,000 like you do in places like Texas. So to me, the fundamental issue with housing and where the relative value is, and I say this with housing, but I also see it with a lot of other real estate, is the fact that land is constrained, and it's constrained not just from a geographic standpoint. Yeah, we have Lake Ontario surrounding us and things like that, but from a policy standpoint, there is no appetite to develop these green fields with housing. And so it's not surprising to me, again, make the comment to Oakville. I have a development that's very close by to me that used to be a golf course. So there's a form of land. They put some detached homes in. I mean, there's barely a foot between the homes beside it, but the pricing of these things are well over $2 million for, a small, 60-foot sort of lot. So, at the end of the day, I think that's the real driver. There's strong demand for ground-oriented homes, very big preference for it, but the land and the opportunity to develop that kind of property just isn't there.
Yeah.
I
I want to go back, sorry, on one thing you mentioned earlier on interest rates, just before I don't want to forget going back to it, because you mentioned the interest rates are rising to more normalized rates. So, as someone who bought my first house, I don't want to tell you how many years ago, but the actual interest rate was over 22%, the real interest rate. And the builder incentive that I got at the time was to do a deal with TD Bank, and they bought down the interest rate. So my real interest rate that I actually paid on my first house was 14 7/8. Okay, 3 years later, when I went to renew, it was down, the real interest rate was at 12%. I thought it was the greatest bargain in the world to go from 14 7/8 to 12. I can't imagine anybody right now having the stomach to pay 12%, but that was the rate back then. But from your point of view, like, what is when you say a normalized interest rate level, like what should it be?
It's a great question, and many economists, are looking at these factors. If we dial back time just before the pandemic, one of the greatest issues that we were talking about was the secular decline in interest rates. I'm going to connect the dots and say that those levels that you were talking about were somewhere around the early 80s, late 70s. From that peak period of time, what we've seen is a global trend towards lower and lower interest rates, right through for about 30, 40 years. Suddenly, we got a little whiff of inflation, and suddenly people are talking about the 70s and 80s again, double-digit interest rates. The factors that got us down to low interest rates today haven't changed. And so why I'm saying that is what drove interest rates up as high as they did, and inflation in the 70s and 80s, was the baby boomer huge increase in demand. We had a massive increase in demand from a large generation that came out and came of age at the same time. We're buying homes, we're going out there, spending, demanding wage increases because they had families that they had to support. And we had a big general rise in inflation. But as that baby boomer trend started to age out, what we've had is a situation where there's a global savings glut. There's a lot of capital out there. And supply of capital being high, demand coming off from a global growth level, the cost of capital should remain low. So my point saying is that, while we're in the cyclical situation of banks adjusting interest rates a little bit higher, off of 0 up to something like 3% on a policy side right now, the chances of it getting into double-digit territory like it was in the 70s and 80s is not going to happen, because the fundamental long-term demographics, the structural drivers of the economy are very different from that period of time. You never say never in my business, because there's always a tail risk that something can happen. But if you put things together, I would say that people should be conditioned for relatively low interest rates from a historical basis. What's low? Well, a 3 to 4% policy rate, 5% on a fixed mortgage is something that makes a lot of sense in this environment. There's a little bit of spread there for inflation versus bond yields. Could it go higher? Yeah, but I think long term, and it's my forecast actually, and the bond markets are even forecasting this, that by 2023, we'll be talking about rate cuts again as the economy slows down. So again, while things are going up right now, that's a cyclical situation. But from a secular standpoint, long term, I think we can be conditioned to keep interest rates relatively low.
Carl, I wanted to talk about the pandemic a little bit. I'm an investor, and I've been looking more at commercial properties to purchase and kind of where the opportunities lie. And I remember during COVID, there was a runner who used to run along Queen Street, and he kept an active note of the empty spaces along Queen Street on his Instagram. And every day he would post, oh, there's a new vacancy along Queen Street. And at one point, I think we were like at 170 vacancies along his running route along Queen Street. So as an investor, of course, I was, excited. I'm like, there's going to be opportunities. These landlords are going to be selling these properties. There's going to be more available commercial property on the market. However, the opposite actually happened. Nobody sold. Nobody listed their commercial properties. There were no opportunities, and commercial landlords did not panic.
Yeah, well,
which is quite the opposite of what anybody would have expected. So, just wanted to get your input on that. Like, I mean, was there ever a stronger message sent of how these landlords and these property owners, how much they believe in the Canadian real estate market?
yeah, this comes down to the fundamental point that I was actually connect the dots to what I was just saying to David before on interest rates. There is a heck of a lot of capital on the sidelines for real estate. Lots of investors, small investors, big investors like pension funds. Pension funds are a good example. They've been shifting their allocations from investment out of stocks and bonds and more towards real estate. But the major reason why they've been doing this is because of that secular decline in interest rates. As interest rates go down, real estate as a relative asset class makes a lot of sense because you can earn a spread that's better than that on bonds. Plus, you get cash flow that continues to grow, plus capital appreciation. So to that point, I think why nobody panicked at this point in time is because they have the capital to withstand it. They, whether it's equity capital or debt capital, there was enough capital there to support it because there's a global glut of savings that's in the economy. Now, vacancy moving up, Queen Street, some of these other retail foot traffic, obviously the pandemic caused a lot of vacancy. I mean, you see it in the path in downtown Toronto where there's still a lot of retail vacancy. The point there, and this is more of a structural issue with Canada, if we're just talking about retail, we don't have a heck of a lot of retail per capita. We're not like the United States where we built retail all over the place. And now as a result, you see a lot of dead malls and things like that. Queen Street is obviously an important foot traffic street. Those places can be reinvented. People are coming back out now for retail and, they're spending, the foot traffic numbers are showing it. So I think there's still a use for a lot of that. And then it comes back to my point, this is land that can't be replicated. Queen Street is Queen Street. Bloor Street is Bloor Street. The demographics, the foot traffic, all the fundamentals that make location important is still there. So yeah, you're going to have some vacancy happening, as a result of the pandemic, e-commerce shifts, these long-term shifts. But what you can't replicate is good land, good location. It's real estate 101. And at the same standpoint, as long as interest rates don't readjust to those double-digit levels where it takes no work to earn, a 13% yield by just buying a bond, then real estate makes a lot of sense. So I think that's really what the issue is behind that.
So what advice would you give to smaller investors, looking to purchase any sort of asset class right now?
Well, again, I think the rules of real estate don't change. One thing that's benefited a lot of real estate investors, whether you talk about it from a residential investment standpoint or a commercial, is the fact of cap rate compression. That compression of yields over the last 20 odd years has really boosted real estate values. And so regardless of what you're doing with cash flow, those values keep going up. you're making money. You're making money on paper, but certainly there's a lot of demand out there. So it's proving to be a good investment. But the point is, you should not rely just on cap rate compression for your investment. Real estate has always been what I call an alpha investment. You don't just passively sit back and let it do the job. You have to work at it. You have to mine income out of it. So you have to do your homework. You have to look at where there's fundamental demand, where your cost basis is, and redevelop when you have to. You have to put in the capex. You can't just let your property slide. All of those factors are very important in an environment where interest rates are shifting, because all interest rates have done, the secular decline of interest rates has lifted the value of our properties. So anybody who's not done anything can still make money off of it.
Right.
It really comes down to the cash flow.
Okay.
Yeah, there's also a bit of a shift, like you mentioned it, in the way people are going to use some of these properties. You got to rethink it, whether you're on Queen Street or and you had space that was retail space that was used by a restaurant that got hammered during the pandemic and had to leave or something. So now what's next? How are you going to reuse that space? Like owners, landlords have to invest some money into these properties too, to change the dynamic a little bit, to figure out how people are going to want to use these spaces going forward, right?
Good, excellent point. I mean, one thing that we used to do, I used to work with a pension fund investor, is look at long wave trends. We're long wave real estate investors. 20, 30 years from now, we may still own that asset. What's the world going to look like? And one trend that we have seen, nobody does, a dedicated retail facility now. Nobody's building malls anymore, because people don't necessarily just do their shopping inside of retail. They do their shopping online. They there's a whole subcurrent of buying reused goods online. All of these long-term changes are affecting the way we do stuff. One of the things that we also saw as Toronto's grown and become more dense, transit usage had picked up quite a bit. And so nodes around transit stations just had lots of people walking by. So to that point, you really have to do your homework. Location is great, but what are people doing there at the end of the day that makes value? The urban trend, 24-hour cities, has driven a lot of residential development inside of urban areas. So areas in the downtown core that used to be, these mom and pop retail stops are now seeing opportunity to develop density where you can with, building a condo. That may not be the option for everybody, but, being able to look at those long-term trends of what people are doing and using can mean a lot in terms of the use and the cash flow for these investments long-term. Mixed use is something that a lot of institutional larger investors are doing. Rather than have just an office building or a retail building, they're doing a mix of all of those uses. Put some residential up, have a little bit of office, have a little bit of retail. All three of these uses all interact with one another to support it. It's kind of, an ecosystem of development. And that's a trend that we're seeing now in big cities in Canada. It was a trend that was going on in Europe for years, but these are the evolutions. So you have to look at the big picture trends when you're looking at development that way.
Yeah, I think we're seeing that, especially we talk about Queen Street or whether it's Dundas or whatever. You see these developments going back in there, so they're knocking down what was storefront retail. Maybe there was two-story, there was a residential apartment above it, and now they've knocked down a block and they're putting up a condo. But it's not just a residential condo. Usually they're putting the retail back on the ground floor with some restaurant uses and some other stuff, a drugstore, or some other things like that. And then sometimes there's a floor or two or a level or two of office space, and then the residential condos above it. We're seeing more and more of those type of developments.
That's exactly it. It's mixed use development. Again, it's the synergies that are developed with mixed uses. You put some residential density on there, call it 100 households that are sitting on top of this box. Well, they need dentist services, they need some drugstore stuff. You've got a captured audience of people that are going to use that retail. At the same time, some of them, the trends have changed. People are working from home, but they might need some office. You could put some office space there and a co-working firm can get in. That's the whole point of that sort of development. flip the lens and go even bigger, there are these major malls in Canada that have big parking lots all over the place. There's a lot of density there for parking lots, even though people aren't using it. So what do you do as an owner of some of these malls? Think of Cloverdale and Etobicoke, a great old mall that, kind of faded a little bit. The developer there has got plans to put up big residential towers around it, keep the retail there so that, all these residential towers come and start shopping again around it. That's the whole point is, figuring out what the highest and best use is. It used to be maybe just putting on a dedicated retail building, but the highest and best use is not necessarily that, particularly in a place like the GTA, where you have 400,000 people a year moving here and you've got very strong population growth and people want to live somewhere. So
Yeah,
I
we're seeing that
I
at
give a
the
big
Promenade
shout out
Mall,
to
too.
smart centers. I mean, when you look at Smart Center and what they have done over the last 5 years, like it's pure genius, I think, right? Because they have all these locations all across the GTA, all across Ontario, all across Canada for that reason. And some of it is absolutely prime real estate. And what they're doing in Vaughan with Transit City.
Yeah.
I mean, I don't even know if people realize what's happening with smart centers and how they're reutilizing their land and redeveloping it and repurposing it. But all these major big box stores, which is just basically land, they have a plan to transition and convert from retail to multi-use different space. And I mean, they're putting up 25 apartment buildings on 100 acres in Vaughan, and they're doing a fabulous job. And for once, they're putting in all the infrastructure first. So the subway went in, the bus stations went in, the light rail tram went in, and it's all being centralized. It's all being planned ahead of the time, and then the buildings are coming. And I mean, I'm assuming that smart centers are going to keep doing this and keep redeveloping all their major properties in this sort of way. And I've been following their stock, and I've been following what they're up to since they're making these announcements. And it's amazing to see them pivot and transition and repurpose some of these properties.
yeah, a great point. It absolutely smart centers is doing that. And just keep on that train of thought with some of the major retail REITs. Look at RioCan. RioCan was the largest retail REIT out there. They had a lot of great sites for retail, but guess what? They're now a residential developer. Their business model has shifted from just pure dedicated retail to developing residential. They've honed in on this whole story of mixed use development, and the opportunity to, what I was saying before, manufacture value, which is what real estate's all about. It's manufacturing value. They are manufacturing value out of the sites that they have for this sort of stuff. Absolutely, I think this is a long-term trend. And, it's surprising coming back to, everybody talked about the Armageddon in retail, the death of retail. Retail REITs are actually the second best performing stocks on the TSX right now. And it's precisely for that reason. They are mining value and creating value by developing retail sites. So there's opportunity to do that. And I think that's exactly where things are going. The other big factor here, we talk about global trends and demographics, but the other side of that is all these municipalities that are out there are totally on board to do this. Urban planning has moved in the direction of, walkable cities, dedicated areas where they want that sort of density. These are trends that have been coming out of Europe for years, and now they're coming even to the suburbs in Canada. So you're now seeing these town centers with a lot of this sort of stuff. To your point about the infrastructure coming in, well, guess what? If you got the municipalities on board, then they make your life easier. So that's exactly what's happening with that. And that's why we're seeing those sort of opportunities happen. Do I think that's going to stop? Probably not, because the other factor here is affordability. If you can create more density, you make things relatively more affordable for people. So that even in the suburbs, where the average single family home price is well over $1 million, you create some density, create some rental residential, because the old stock of rental is just not there. It's been built back in the 70s and 80s, but new residential around these town centers that you can rent. Long term, I think those are great trends that a lot of companies are capitalizing on.
Carl, maybe we shift gears a little bit and talk a little about the office market too, and what you're seeing there. Again, some of this conversation comes out of changing needs that everybody sort of became aware of during the pandemic, like how much space do you really need, people working from home, things like that. But now there's generally a push to get people back to the office. And what are you seeing out there with the office market?
Well, again, a little bit of context is important here. Going into the pandemic, Toronto, if we talk about the downtown office market in Toronto had one of the lowest vacancy rates in the world. In North America, at least, definitely one of the lowest. It was tripping at 2%. Vancouver was like at 1%. This whole idea of people, 24-hour cities, live, work, and play downtown, that really drove a lot of activity into the office market. But underlying a lot of that trend was technological changes. People were developing technologies that were there, not just for the way we work, with Zoom and conferencing and that, but even building technologies, more efficiently run buildings, HVAC systems, more flexible floor plates. So we have these trends happening, and then all of a sudden we have this pandemic where we could institute a real live experiment with work from home. And all companies did it. The bigger companies were managed to mobilize things much faster and have the technology in place to do it. And this real world experiment actually saw productivity improve with many of these firms. Things actually got more productive as people were working from home. Productivity is a bit of a catchword because depending on who you ask, it's defined in different ways. Is somebody who's being productive if they take a break at 3 o'clock in the afternoon to go running, when they used to be in the office at 3 o'clock in a meeting, but they're going to make that up, later on tonight when they have the flexibility to define their own time. So productivity is used in different ways, but the reality is, and why I say this, is that when you look at the actual productivity, the output per worker and profitability of companies, they were productive with this. At the same time, I think a lot of workers, office workers in general, realize that having that flexibility, and particularly the ability to stay at home where you didn't have to engage in a 2-hour commute downtown or do that, was a great perk to have. And so coming out of this whole pandemic, all of a sudden you try and tell people to go back to work. Well, now, what am I going to do with the last 2 hours? You get a lot of pushback. And that's happening mainly in big cities. It's happening in Toronto, but we're also seeing the same thing happening in the UK, other major office markets where people are doing this. Flexibility is there. Why workers are being able to push back is another big trend that's happened. We've seen an unemployment rate that's been at all-time lows. It's a workers' market out there. And people are saying, well, if it's a workers' market, even companies are saying, well, I'll give you a little bit of a raise, increase some wage inflation to get you back to the office. Well, that's not cutting it. That's not what people want. They want the flexibility depending on where you're going. So that in itself is a major trend for the office market. And what we're seeing right now from a metric standpoint in the office market, and I'm just talking about downtown office, is a substantial increase in sublease availability. Many big firms are putting their excess space because their workers aren't coming into the office onto the sublease market. And that's helping to push up vacancy. And the vacancy is now starting to creep higher and higher, particularly in places like the financial core where the big banks and big organizations and big law firms are. And the other big trend, and this is more unique to Toronto, is we also have a very big new supply pipeline coming into the market. You go downtown Toronto, you see all that development in the South Core, CIBC Place right by Union Station, the new Cadillac Fairview Tower that's happening in the Well. All of this new product is coming in, and this new product has really great HVACs, really flexible floor spaces, dedicated towers, a lot of that mixed use that we were talking about, and demand that used to be in the core for these guys that had all the space is now migrating to these new spaces, but they're taking less floor space than they needed from before. So the net result of that new supply plus relatively lower demand is going to keep our vacancy rates relatively high for the indefinite future. It's just an arithmetic sort of equation to kind of put that together. And we do see vacancy remaining high as the office market shifts. But like all real estate, you have to look at off the headline numbers. And the best buildings, the most flexible, the newest ones, they'll see the low vacancy, high rates. But the older buildings that can't compete on HVACs, great flexible floor spaces, maybe a little bit dated with not great amenities, that's where we're seeing the vacancy happen. And I think that's going to be a structural trend for the next few years. So anybody who's saying, I'll say this is my last comment. Anybody who's saying, well, this work from home trend or hybrid working or all that sort of thing is a one-off and things are going to shift, I don't think so. I think we've fundamentally seen a very big change in the way we do work. And that's going to have a meaningful impact on office demand over time.
So is the vacancy rate high enough at this point that it's affecting the per square foot rental rates that the landlords are getting?
Yeah, absolutely. I mean, we are seeing, rental rate growth is now flat to slightly negative. Year-over-year changes on that per square foot number is now starting to come off. Now that, as an investor, that's a little bit troubling because, if you're investing in real estate as a hedge against inflation, and inflation is growing at 7-8%, but you can't even recover, 2% on your office cash flows through rent growth. Plus you're investing in CapEx into that building, right? Over and over. That has an impact on office returns. I imagine we'll start to see a lot more of that come through as values start to adjust and everything else. But yeah, absolutely. We were not seeing the kind of rent growth, in the office market with vacancy as high. And that makes a lot of sense. The market is now shifted in the favor of tenants as opposed to landlords, and they can dictate. So the net effective rents, when you look at incentives and all that sort of stuff that's, come into play, I think the net effective rent is slowly going to get whittled away, which means that the year-over-year increases in rent are going to come off to some extent too.
So Carl, I have a little bit more of a personal question for you. I'm actually just in the
dating advice.
Yes, I'm actually just in the process of obtaining a new commercial mortgage in my commercial building. What should I do? Should I lock it in for 1 year, 3 years, 5 years, go variable? What will your advice be?
Well, commercial is a different story than residential. Commercial, I would lock it in just because, you want to have a surety of cash flow. You can perform that stuff, because your income might be shifting. That's why in a commercial standpoint, I would go that way. That said, from a personal standpoint, I always believe variable rates are the best. General reason why is a very elementary reason. Yield curves, the shape of interest rates on a yield curve are always upward sloping, which means that shorter dated or not fixed rates, but short dates tend to be lower on average than longer rates. So on average, you're always going to have a lower interest rate, taking a variable rate mortgage. There are exceptions, like right now where the yield curve inverts and short rates are higher than long rates. But those are the exceptions when you're going into what is effectively a recession, which is what I believe we're heading towards a recession just by the inversion of the yield curve. And what that means is that where those high rates are right now, at some point, the Bank of Canada is going to have to drop those short rates back down so that your yield curve is going back up again. And that's why when you look at it over the holding period, you do better with a short rate on debt. So that's my personal belief, and I put my money where my mouth is. I only did once a fixed rate mortgage on a residential building, and it was fine when as a first time buyer to do that. But after a while, I realized, look, I'm paying this much, but now rates are down here. That's the opportunity cost, right?
So would you do a 1 year fixed rate or a 3 year fixed rate?
If you're going to do a fixed rate, again, it just depends on where things are. I've done 1 year fixed rates just to hold rates, but again, it depends on your view and doing a fixed rate is insurance. So, what's your risk on your horizon in 1 year versus 3 years? So it really just depends on your personal situation. Taking out a fixed rate just gives you peace of mind. So, how much peace of mind are you willing to pay for?
I think David's really trying not to have a view and wants to rely on your view.
Exactly.
Well, there's the danger, right? I mean, I think that's the thing is in real estate, in my career, I've seen herd mentality govern things. Well, everybody's doing it, but when the winds change, the herd goes off the cliff. So it really just depends on where your personal situation is in your in the situation with that building.
Hey, Carl, you used the R word a minute ago, recession. So like maybe expand on that, what you think is going to happen the next 3, 6, 9 months, a year. Where are we going?
I'm of the camp. I think there's about a 50 to 60% chance that we're in a recession by 2023. Here's the reason why. There's a couple of reasons. First of all, again, I'll just say it simply, the yield curve doesn't lie. The yield curve is so deep into inversion territory right now that historically it's always done a great job of predicting recessions. So the yield curve is saying that. From a fundamental standpoint, I think, slamming the brakes on the economy as hard as central banks are doing by raising interest rates is going to filter through so hard on the economy that's been conditioned on low rates. So the backup in spending, and the backup in activity, which has been sustaining the economy. I think a lot of people don't realize how important real estate is to GDP growth in Canada. It's far higher than it is in the United States. It's a big chunk. It's a bigger chunk of contribution to the economy than manufacturing is. So you put the brakes on that side of the economy as hard as it is, it doesn't take long to induce a recession. The other reason why I say this is it's not just a Canadian phenomenon. You look at the United States right now, they've had 2 successive quarters of negative growth. That technically is a recession. The only reason why nobody's calling it a recession is because the labor market is as tight as it is. But, I'm a little bit different here. I think the labor market can be tight with a low unemployment rate, and you can still have recession. Japan's been doing it for years. They've had a very low unemployment rate. At the same time, GDP growth has gone nowhere. I think the factors that are driving unemployment lower in the United States is the same factors that drove Japan, their demographic factors that happened 20 years ago to Japan. So I think that globally the world is slowing. I think these higher interest rates, as quickly and as sharply as they're happening is going to put the brakes on things. I think inflation, people's pocketbooks are getting squashed with, buying, food at the grocery stores, or, at least there's some let up in the gas tanks. But I think all of that just says that we're going to be heading into a recession sometime soon. And as a result of that, I think interest rates will, come off again. I'm not just saying this, financial markets are pricing in rate cuts by next year at this time in the United States. So, there's definitely a view that I'm not the only one thinking that recession is likely.
So 1-year fixed rate is what you're saying.
Yeah. If you're looking for the backdoor answer, yeah, I think that's right.
That could be good news on the residential side too, because a lot of people are concerned with the fact, that they bought a house in the last couple of years, they had a 2-year, 3-year mortgage that's coming due, and they're saying, oh my God, what's going to happen when this comes due? I had like such a low rate before, now I'm going to be at 5%, 6%, or some higher rate. But by the time some of these come due, maybe, by next spring or something like that, the rates might actually be pushing back down a little bit.
And we're all in the United States, you're actually already seeing that. The mortgage market in the US is different than Canada's. The 30-year mortgage there is priced off of bonds. So you get an immediate reaction when long-term bond yields start to come down. So you're actually now starting to see already in the United States lower refi rates on their mortgages. In Canada, we haven't seen that yet, given the way the mortgage market is. But yeah, I mean, as supply and demand shifts by next year, if bond yields continue to head lower, again, I'm talking about that inverted yield curve where long-term bond yields are going down, that will eventually come back into mortgage rates, and you may be able to refinance at a relatively low mortgage rate again. That could induce more activity. Long story short, as I think, I don't see double-digit interest rates in the horizon over the next few years. If anything, I see rates backing off from the rates that the central banks are pushing right now, and they will need to come off. Whether they go really low, like the pandemic, I don't think so. I don't think we're going back to zero. But again, a 3-4% interest rate is not something that's going to, kill the housing market, but may actually pull people back into the market to some extent.
Yeah, so there's some good news out there, even if there is a recession, because that actually could, right?
I'm reticent to say that, because I think in our industry, a lot of real estate commentators get excited about the prospect of recession because it lowers interest rates. Let's not forget that recession also means that demand falls off. So if demand falls off, cash flows can be impacted by, your commercial real estate and stuff like that. There's two sides of the same coin. But generally speaking, I think, from a cyclical economic standpoint, recession is probably inevitable in some ways. Although I'm putting a 60% probability on it. And that is going to set the stage for rates backing up to some extent.
Carl, there's been so much talk over the years about foreign investment into into the Canadian economy, and nobody seems to really understand what those true numbers are really all about. Do you guys, do you guys track how much foreign investment money is actually coming into Canada?
Well, we try to. One of the great things with CoStar data is we actually have true owner. So, there's a lot of these numbered companies that come in that are on the ownership documents, but we do our best. And, why CoStar is kind of good is you can drill down to the property, and instead of saying Ontario 1, 2, 3, 4, 5 Corp, you can actually see who the true owner is, who could be a foreign buyer, right? And they set up a thing. That happens quite rampantly in here. The Statistics Canada and the federal government is now tracking that. And remember back in 2017, they put in some of those foreign buyer restrictions and stuff like that. The last stats that I've seen on an aggregate level, they're anywhere between 10 and 15% of the market is dominated by foreign investors. I'm talking residential here.
Okay.
Is dominated by foreign buyers. That being said, we're saying Toronto is 10 to 15, but if you go into enclaves like Richmond Hill or submarkets, that impact may be much larger. And that's the problem with averages when you come into the real estate market. And that's absolutely the case in Vancouver. Vancouver has a lot of foreign money that's driving the real estate market. It's not the incomes generated in Vancouver that's driving up property prices there. It's foreign money that's coming in. So it is a material number that is moving the market. That being said, some of these restrictions have kind of pulled back some of the investment that's coming from foreign buyers. At the same time, take a place like China, where there's currency controls and controls on money coming out of the country right now, and all these sort of things, that's pulled back a little bit of the foreign buyer demand as well. So we have to take that with a grain of salt. My last comment on this is, I've done a couple of real estate forums and, discussions and in panels, and lots of people say, well, these are foreign buyers, he looks Chinese, he looks Indian, these are foreign buyers. No, they're Canadians who are that, from that ethnic background. And many of those people in those ethnic backgrounds pool capital together, and they can look like big investors and do that, but that's just, that background. So we have to disentangle a little bit of that in the market as well.
But 10 to 15% is probably the highest percentage that I've heard coming from any reputable source. You read newspaper articles and you look at some other published media, and those percentages are much lower. I tend to agree with you. I think there is a lot of foreign money flowing into Canada, and I think some of those restrictive measures that you discuss, even though on the surface they are restrictive in nature, I think they do their part to expedite some of the money flowing out of the countries through back levels, because business owners and above average people in those countries want to safeguard their wealth and want to protect it, and don't want their own government to have a say. So they do the best that they can to get the money out of those countries and invest in different real estate all over the world.
Yeah, you can't, my dealings when I used to work for a pension fund and used to go out and sell Canada to foreign investors, And why Canada? Well, we're a great place, a security place to keep your capital. It's a safe place. Absolutely true. And most foreign investors look at Canada that way. It is a great place to store it's a safe place to keep your capital. And that's what does drive, investment in real estate, whether we're talking residential or even commercial real estate. RBC Tower in downtown Toronto, one of the biggest transactions that happened in Toronto was by a foreign investor, the guy who owns Zara, the Spanish billionaire. People see the safety and security of Canadian real estate, and I think that's a big incentive to come here. The only problem is, obviously that capital is competing with domestic capital, and then it encourages a little bit of resentment when people can't afford things. I don't think it's foreign buyers that are driving up pricing. 10%, 1 out of 10 people buying homes in Canada foreign. That's not what's going to push the market up. It's going to be everything else too. But at the margin, you're competing with those buyers. So that's all for an issue. So
yeah, we do a lot of work in the Chinese community, and I've been saying this since NRST first came in 2017. We're doing seminars and webinars on it, and all the investors were coming in there saying, okay, it's going to cost us 15% more. Okay, still going to do it. It's not a deterrent. And now we're just running around telling everybody, it's by the way, it's 20% now. And say, okay, so it's costing another 5%. Not slowing them down from doing it because it's still a good investment. They still rather their money here than in China or some other country. And it's just, okay, I'm going to make 15, 20% less. And I think the government knows this too. And they just say, oh, okay, it's not going to really affect the real estate market, but we're going to get 15 or 20% of the action. This is great money for us.
David, I think you're absolutely correct. I think the government knows that full well. It's just a cash cow for them.
Yeah.
I've said this before. I think the policy from the federal government is to keep the housing market going as much as they can because it makes money for them. It keeps the economy going. So, while they're doing this, I think they knew full well that wasn't going to backstop the market. It's just a signal to the constituents that they're doing something about foreign buyers, but they know that that's not going to do anything. And at the same time, they're getting revenue coming back. So I'm totally on the same place with you on that.
Yeah, and 20% seems like a large number, but you have to put into context. It's over the life of the property, right? So, 20% over 20 years, might seem like a high number, but what's the time period that you're evaluating a percentage over? And it's over the whole ownership of the property and the asset class, right? So, it seems like a large number up front, but if you keep the property for 20 years, you divide, if it's $1 million property, you divide 200,000 by 10 years, and it's costing you an extra $20,000 a year of ownership, right? So, still much better than keeping the money in your own country where politically unstable, massive corruption, high inflation. Governments are introducing different taxes every day to take that money from you, and you have very little control over what that looks like.
Yeah. It's all about opportunity cost, to use an economist term. And obviously the costs are far bigger than that 20% tax that they're facing here. So,
Carl, one question I have as a follow-up is, when you're looking at statistical data and you're looking at the number of transactions in the market, what percentage of those transactions are investor driven in the residential market?
So CMHC has done a bit of a study on this. The numbers are all over the place. I'm quoting what CMHC has said. And predominantly they're looking at the condo market. I don't know what the investor market is for detached homes, but from the condo market, upwards of 50% are investors.
50?
50. It's a remarkably high number. In Toronto, it's dominated by Toronto and Vancouver as investor driven. So that's where CMHC kind of sees it. Anecdotally, you can go around a building downtown Toronto, which I know a couple firms that have done this sort of thing, gone into the building, canvassed the owners in the condo, and half of them are renters. So that kind of tells you something as well. Airbnb, obviously, they've recently been forced to put a bit of a lid on it because it's been a cash cow for a lot of people to make these into short-term rentals, and I've heard that Airbnb has had to adjust their policies coming out of the a government policy to say no more short-term rentals, because that's been a big cash cow for a lot of people as well, buying properties, making it a short-term rental and, obviously doing that. So that's been a big incentive as well for investors. But yeah, it's definitely a big chunk of the market in the condo market.
Awesome. Okay.
Well, Carl, we really appreciate you coming on today, and we want to be respectful of your time. I'm sure it's very valuable times. A lot of people want to hear from you all day long, and this has been really insightful for us and helpful. And I really hope that we do a good job pushing this out to get all everybody who's ever listened or watched one of our podcasts to watch this one in particular, because this was fabulous. Thanks, Carl.
Absolutely. Thank you very much. It's been fun. We could talk for hours.
We
We
absolutely
might take you up on that.
That's good.
Thank you, Carl.
All right. Thanks a lot. Take care.